Let's start with equity. Not discussing those chapters, company analysis, industry analysis, and all. Apart from that, I'll discuss everything. First chapter, market organization and structure. If you observe this chapter, it is largely a repetition of whatever we have learned in derivatives, fixed income, alternative investments. So it's like a culmination of all the subjects taken together. Okay. Now, what are the purposes of financial system and all? Highly obvious: risk management, issuing capital, borrowing, lending, all those activities. Okay, where the savers meet borrowers, typical definitions and stuff. Participants: brokers, prime brokers, block brokers. What are prime brokers? Prime brokers are the brokers who help the hedge funds and all in giving loans for the hedge funds to be able to do leverage trading. Okay, block brokers are, you remember block brokers help the clients to execute big trades. I might not want to reveal my intention to the market, so I will outsource this function to a broker who's a block broker with his experience and all, which will put such trades so that market doesn't know of the intention. If I put such a big trade together, it will appear in the bid and ask column, and accordingly the markets may adjust their prices. Okay, if they are seeing someone who's wanting to sell such a big quantity, everyone start bidding lower prices. If they are observing someone wants to buy a bigger quantity, everyone will start keeping very high offer prices. Yes. Okay, then physical derivatives, financial derivatives. Physical derivatives will be mostly on what? Physical derivatives will be on tangible items like commodities and all. Okay, financial derivatives will be on stocks, bonds, currency, etc. Then talking about the difference between debt and equity, it's better not to talk. We discussed several times now, these are extremely basics. Okay, primary market, secondary market. Discussed in fixed income: primary market, new issuance market; secondary market for subsequent trading. Traditional alternative investments difference I need not discuss. So it's always advisable that if you want to watch this video, watch after derivatives, fixed income, alternative investments. By then you would be knowing a lot of stuff already, so that I don't need to repeat the same stuff again and again for this. Okay, fine. Now talking about equity securities: common stock, preferred stock, warrants. In preferred stock, there are three types: normal preference shares, participating preference shares, such that preference shareholders have the option to participate in excess profits of the company. Then there were cumulative preference shares. So for example, if a particular year the company is not able to give dividends, preference dividends, due to losses, so next year the company, whenever it makes profits, will have to give that year's dividends plus the previous year's dividends which it couldn't give due to losses, was cumulative preference shares. And finally, convertible preference shares, which can be converted to equity shares of the company. Now when I discuss about equity, it's of two types: class A, class B shares. Remember, class A share owners will have voting rights and all, but they will get lesser dividends. I have to attract class B shareholders by giving them more dividends, but then I don't give them any control, voting rights and all that stuff. Okay, fine. In India, we had discussed which three companies were having, out of which two of them have gone bankrupt. Now, Tata Motors also has cancelled its differential voting right shares, DVR shares. Now it will be one category only overall. Warren Buffett's Berkshire Hathaway had two categories of shares, Class A, Class B. Which shares will trade at a discount, Class A or Class B? Class B, because they don't have any rights, and also Class B shares will trade at a significant discount to their counterparts, Class A shares. Okay, now discussing about warrants, already discussed in fixed income. Sweeteners. Okay, you now know the accounting treatment also of warrants when it comes to diluted EPS: AMP minus EP upon AMP into number of options. Yes. Okay, fine. Now discussing about pooled investments, extensively discussed in alternative investments: mutual funds, ETFs, exchange traded funds, private equity, venture capital, hedge funds, all these pooled investment vehicles. Okay, now again I repeat, ETFs are structured as open-ended funds or closed-ended funds? Open-ended funds. They trade like closed-ended funds on the secondary market, but structure is open-ended. Creation units, don't forget that. It's not mentioned in your book, but you need to know that. That question also we had solved. Okay. Now, when it comes to contracts, forward contract, futures contract, option contract, swap contract, we have discussed everything in derivatives. Currency, normal currency, reserve currency, US dollar, pound, euro, Japanese yen, Chinese yuan, Swiss franc. All these are what reserve currencies, which majorly all the central bank hold. Okay, fine. Now I'm not discussing the options. We have discussed, if you want to watch the options, you go to the derivatives lecture. Let us not waste time discussing the same things again and again. Okay. So can I just discuss the incremental part from this chapter, which we have not previously discussed? Okay, fine. Now I've already discussed what are block brokers and or dealers, brokers. We already know ATS, alternative trading systems. In that we had learned dark pools, where you want to hide your intentions. So whatever sell order you are putting, you don't necessarily know if there is a buy order of the same quantity. That is what is the beauty of dark pools, right? The fact will come, the markets will know of the trade only post facto. They won't come to know before that. Only post facto knowledge will be given to the markets. Securitization, they have discussed again. Securitization extensively discussed in fixed income. Okay. Then your insurance companies, 3 risks exist with insurance companies. Fraud, that factory example, if you remember. Moral hazard, I bought a Bentley, started driving it very fast. Moral hazard. And adverse selection, smoker, non-smoker example. I'm just giving you the touching points example so that you remember. Okay, fine. Arbitrager is what? Risk free profit and a guaranteed profit. Arbitrage is what? A guaranteed profit. We had discussed several ways of executing arbitrage: cash and carry, reverse cash and carry. In options also I taught you put call parity. So many ways of executing arbitrage. I think I had shown you the actual put call parity also in class, how it is done in the markets. Okay, fine. Now coming to leveraged returns discussed in quants. Okay, whatever the returns of the stock, you subtract all your charges, interest charges, admin charges and all that, and you magnify it by what? Leverage ratio. Leverage ratio is 1 upon own money. Additionally, if they give you any commissions and all, just be careful about that. Okay, fine. So short selling is how you are not owning the stock, but still you want to take an advantage of the price fall. So first you borrow the stock, sell it, receive money. That money you will have to keep it as collateral. That party which has lent you the shares, you will have to give lending fees to the party. Now that party will deposit that money somewhere, the collateral money, it will earn interest on it. A part of the interest will be given to us as short sellers at a rate called as short rebate rate, and then I will hopefully look to cover the position at a lower price, and the difference will be my profit. At that time, during time of short selling and all, whatever dividends are declared by the company, do they belong to me as a short seller or to the lender of shares? Remember that. Okay, it doesn't belong to me. Okay, now in leveraged positions, one thing I want to specifically clarify is in futures also is a leveraged position indirectly. Now when your margin balance in future falls below the maintenance margin, how much additional cash you have to deposit? As much as just to bring it back to the initial margin level. But one thing you have to remember when it comes to stock, when you buy stock in a cash segment with leverage, in cash segment also you can buy stocks on leverage, on borrowed money. In that case also margin requirements would be applicable. But here when your margin balance goes below the maintenance margin, you have to deposit additional cash to get till the maintenance margin level only. Here you don't have to get it back to the initial margin level. So this one key difference that you have to know. Okay, fine. Then we had discussed that concept also, margin call. At what price will you receive margin call? The formula is PO, original price, in brackets 1 minus initial margin upon 1 minus maintenance. I had discussed the entire logic of the formula, but then ultimately for exam purposes you know the formula. Okay, logically you should know how it is derived. Okay, skin in the game concept that I had taught you. Okay, thereafter, what is a long position, what is a short position, that all you should know by now. Okay, will you confuse the long and short position with options? please. Option functions in a different world altogether. In options, long position simply means option buyer. Then you will have to see the side, call ya put, like that. Short position in options means option seller, option writer. Okay, then you will have to see the side whether it is call or put, right? Okay, in interest rate futures also don't confuse long and short. There also things function differently. Okay, now when it comes to bid and ask concept, bid ask spread, when you want to buy, the opposite party will sell. So you should always look at the ask rate. If you want to buy, ask rate is also called offer rate. If you want to sell, the opposite party will buy. The opposite party will buy at the bid rate. Bid and ask always have to be seen from counterparty's point of view. Okay, so ask rate will always be greater than the bid rate. That's how they make money, the dealers. And more the spread, the difference between the two is called spread. Bid ask spread is an indicator of what? Liquidity. Lesser the spread, more the liquidity. We had discussed the reason why. More the spread, lesser the liquidity. Yes, okay, fine. Now talking about the various types of orders, execution instructions. In execution instructions, it was marketable order and limit order. Market order and limit order. Market order means what? I place a market order to buy, it will be executed at what price? Current market price. I place a market order to sell, it will be executed at what price? Current market. But if I place a limit order to buy, say for example current market price is 100 and I place a limit order to buy at 105, what about it? It won't wait for it to touch 100. Market price is 100, I have placed a limit order to buy at 105. Market price is less than, I am willing to buy at a higher price, it will get executed at 100. The moment you get a favorable price, it will get executed. But if the market price is 100 and if I place a limit buy order at 90, then it will have to wait till the time it touches 90. Once it touches 90, I can buy it. It will be automatically executed. Now for that you will have to then check the validity instructions. I mean, for how long is the order valid? I had told you in India, if you place a limit order, it is valid for a period of 1 day. Till 3:30, if it doesn't get executed, it will be cancelled. Next day you will have to put in a fresh limit order. Similarly, you can put a limit order to sell. Now if the market price is 100, I have put a limit order to sell at 98. I am willing to sell at lower price, but a better price is available, it will get sold at 100, like that. But if the market price is 100, I place a limit order to sell at 120, then you will have to wait till the time market price touches 1. Now contrast this with stop orders, very important distinction. If market price is 100 and if I place a stop buy order at 105, I am willing to buy at a price above 100, but then it will not get executed at 100. It will rigidly, compulsorily get executed only once the market price touches 105. I don't want to buy it at 100. I want to test the waters. If it goes to 105, then I have that conviction that it will rise further. So I don't mind paying 5 rupees extra as compared to current market price, but I want that validation from the market that it is really going up or no. So if you want that validation from the market, you place a stop buy order rather than a limit order to buy. This key difference you need to understand. And stop sell order will be placed at a price below the current market price. It is what? A stop loss order. Stop loss, you all know. Traders, investors have to put a stop loss which is recommended. It's not compulsory, it's recommended, like that. Then if you remember, I had shown you actual market mein how the orders are placed, which are the various types of orders and all. Minute wise order you can also place, which will be applicable for 1 minute, which was typically called fill or kill order. Fill or kill order, also called immediate or cancel order. Now all these fancy orders that I am discussing are applicable in India also. Okay, fill or kill. Then all or nothing orders. So if I place a buy order of 1000 shares and if the market is willing to offer only 500 shares, I don't want. Either I want all 1000 shares or I want nothing, all or nothing, like that. Okay, fine. Also called as what? Fill or kill orders. All or nothing orders are also called as fill or kill orders. Okay, fine. Just one correction I would like to make. Immediate or cancel orders are called fill or kill orders. All or nothing orders don't have any other name. Immediate or cancel orders, other name is fill or kill orders. Now all these fancy orders, fill or kill and all, they fall under validity instructions. Execution में market limit order, validity instructions में you have all these orders. Good till cancelled order. Now I had shown you one good till triggered order which was applicable valid for a period of 1 year. Zerodha provides that option which I had shown you. GTT. You have to create a GTT, good till triggered. 1 year, up to 1 year validity, like that. Theoretically speaking, good till cancelled order means it will be valid until the time it doesn't get executed, like that. Okay. In India, we don't have that. It will be valid up to a period of 1 year, or maybe if some other broker is offering a higher period, then in that case, maybe up to that much time. Okay. Now, market on close orders, it will get executed at the closing market price. Good on open orders, it will get executed at the opening market price. And we had discussed two types of markets: call market, continuous market. Continuous market is your 9:15 to 3:30 market. Call market is what? Pre-market, you remember 15 minutes I had told you that entire procedure. 9 to 9:07 you have to place orders. 7 to 8, 9:07 to 9:08, 1 minute break. 9:08 to 9:15 order consolidation and all. And how is the opening price determined? I had shown you the entire procedure. That opening price pay or good on open order will get executed if you at all you have placed that order, right? Okay, fine. Then when there are circuit breakers during normal market hours, the trading gets halted for some time. COVID example and all we had taken, there are several criteria. Okay, if it happens before 1 o'clock, after 1 o'clock, then situations and all you'll have to see. So once the trading is halted, then it doesn't start immediately. There is some buffer time during which traders can put buy sell orders. So that again I call it call market. Okay, then break, then again order consolidation, then finally market starts, which is called continuous market. Okay, fine. Fine. After that, when it comes to IPO and all, the book building process. Book building process is what I, as an investment banker, will help the company determine the bandwidth, price band, upper bound, lower bound. Then I will market this offer. I will conduct road shows and all to potential investors and all, gauge their demand. All this process is called what? Book building process. Collecting orders and stuff from institutional investors. Basis that I can tweak the price and then finally I determine a price. What should be the bandwidth? Okay, fine. Now, could there be only one investment banker, or there could be multiple investment bankers also managing the issue? There could be multiple investment bankers managing the same issue. For bigger issue sizes, it is always advisable to have multiple investment bankers because of their respective contacts. Among them, one will be the head of all, which is called as lead investment banker. Yes, remember all this? Okay. Now, coming to underwritten offering, best efforts offering, already discussed in fixed income. Fine. Private placement, shelf registration already discussed. Private placement is what? Instead of going for public offering, I would approach institutional investors and issue my shares or bonds, whatever the case may be, to such institutional investors. The benefit is that it will be done faster and terms and conditions also could be negotiated mutually. In a public offering, terms and conditions are not negotiable individually with every investor, but in case of private placement, they are. So that again is a benefit. Okay. Rights offering is what? As existing shareholders of the company, I give you the right but not the obligation to subscribe to my company's shares, but at a discounted price. Whatever is the market price, you can subscribe it at a discount. So there would be a ratio mentioned always. 1:3. So for every 3 shares that you currently hold, you can subscribe for 1 right share. If you don't want to exercise the rights, can you sell it to someone? Yes, your rights are tradable. You can sell it to someone and earn money out of it. Okay, fine. Then discussing about the market structures. Quote driven market is where trading would happen on the basis of quotes given by the dealer. So typical example for this is bond markets, corporate bonds. It's a quote driven market, bid and ask quotes. Order driven markets, your equities. Once you place the order, it can get executed like that on the stock exchange. Order driven market. And then there are brokered markets. Brokered markets is where a broker will have to be involved. For example, real estate, it's a brokered market. There are no quotes, bid and ask and all. Not order driven market that once you place your order it gets executed. It's a brokered market. Other example of brokered market was art. If you want to buy or sell art pieces, then again brokers will have to be involved like that. Okay. Now market information mein we had pre-trade transparent, post-trade transparent. Pre-trade transparent means what? If I place a big order and an open order, I mean, I don't want to hide it, it is pre-trade transparent. I mean, other participants can see in the market, they won't come to know the identity, but they will come to know at least someone who has placed such a big. Now once an order gets executed in the dark pool, the market will come to know only after that. That is called post-trade transparent. After the trade happens, then only market will come to know, like that. Getting it? Okay, fine. And yes, that basic theory, you just read it, that what is the purpose of having accounting standards and all. It leads to better presentation of financial statements, and in the market the regulators and all are there to ensure that insider trading and all doesn't happen, markets function smoothly, fairly, etc. Fine. Okay, so in this chapter, one important thing was we had discussed numerical questions on bid and ask. If you remember that there were so many bidders, bidder, now let me discuss that. What is the market? If I just ask you that much, what is the market? 13, 14. Market means the best bid and the best offer. Which is the best bid? 13. Best offer is 14. Okay, best offer is 14. So that constitutes the market. Now, for example, a person puts a bid at 13.5. Will it get executed? No, it won't get executed, because the minimum that the opposite party is willing to offer is at 14. So 13.5 order won't get executed, rather than that it will come and sit in the order book 13.5. So this is set to make a new market. Make a new market. If I place a buy order at 13, will it get executed? No, because the offer is minimum 14. So if I place a buy order at 13, it won't get executed, it will simply add to the list. So I am said to be a market maker. Market maker. If I place a buy order at 14, will it get executed? I am said to be a market taker. Do you remember all these concepts? Okay. If I place a buy order at 6 rupees behind the market, market is what? Current market now is 13.5, 14. So if I place a buy order at 6, it's behind the market. Okay, fine. If I place a buy order at 12, it is said to be behind the market only, because it is behind this, no? Anything behind this and this is behind the market order. If I place a buy order at 6 rupees, it is literally way behind the market. It is called far away from the market. Far away from the market. Getting it? Okay. So you should be knowing these terms. Inside the market is when, see, now the market is 13.5 and 14. I place a buy order at 13.7. Now this is inside the market and it will make a new market. So these terms are extremely critical. We had done multiple such questions in class. Remember? Okay, fine. Then they were asking you to calculate weighted average price of the trade. Such questions also we had done. Now, in terms of priority, first priority is given to price or time? Price. First priority is always given to price of the order. Okay. Second priority is always given to open order, not hidden order. Hidden order get lower priority. Open orders get higher priority. And finally, priority is given to time. Last. Again, we had done one such question on that concept. First, I repeat, first priority always to be given to price. Second, whether it is hidden or open. And lastly, it should be on time. Okay, fine. Proceed. Okay. Now discussing the second chapter, security market indexes. Now there are various methods of index construction. Price weighted index, equal weighted index, market cap weighted index. Okay. Fundamental weighting. Which is the most commonly used method? Market cap weighted index. and that too market cap has to be decided on the basis of number of shares or free float number of shares. Free float number of shares. Free float is the number of shares which is available to the investing public to trade. Yes, excluding controlling shareholders and promoters and all those shareholders. Fine. Okay. Nifty 50 is determined, the weightages are determined on the basis of market cap, free float market cap. Okay. Some indexes are price weighted indexes, like the Dow Jones Industrial Average is a price weighted index. Some indexes are equal weighted indexes. In India also we have equal weighted indexes, but not so widely used as compared to Nifty 50 and Sensex, right? Okay. Now what was important here in these concepts was the calculation part, how to calculate the returns of a price weighted index. Now roughly discussing how to calculate returns of a price weighted index. Now in a price weighted index there will be two types of returns, price return, total return. In every method there will be two types, price return, total return, price return, total return. What is the difference between price return and total return? In total return, we'll be considering dividends. In price return, we'll only consider the price appreciation or depreciation, right? So if I have to calculate the price return index ka price return, of course, I won't consider dividends. I will take the average price at time 0 and say, for example, it's a 1 year investment. I will take the average price at time 1, then I will see the percentage appreciation. That will be the price return index. Now, logically, I had explained you the logic why we do such a method in Excel. If you remember, don't just mug up the formulas, know the underlying reasoning behind it. Equal weighted index, individually we calculate the returns of each stock, and then whatever returns we get in percentage terms, we take the average of equal weighted index, right? Okay. In price weighted index, what happens is you are investing in equal number of shares. If there are 3 shares in the index A, B, C, equal number of shares, 100, 100, 100, 200, 200, 200, like that. In equal weighted index, what happens? You are investing equal amounts. If you have 3 lakh rupees, then in 3 shares A, B, C, lakh. If you have 6 lakh rupees, then 2 lakh, 2 lakh, 2 lakh, write that. In market cap weighted index, majority of the weightage is given to high market cap companies. So you tend to invest more and more in there. Just for an example, Nifty 50, the highest weightage in Nifty 50 is of Reliance Industries. So if you do a passive investment, so most of your weightage will be towards Nifty 50. Reliance Industries, sorry. Okay, and then how to calculate the returns of market cap weighted index? Number of shares into the current price, like that you will get the total market cap currently, and the same exercise you have to repeat after 1 year. Number of shares into market price at that point, and then whatever the market cap appreciation, you have to take a percentage on that. Of course, if it is price return, ignore dividends. If it is total return, do consider dividends. Okay, fine. Now what happens is, for example, in an equal weighted index, a small cap has performed extremely well. So equal weighted index mein small cap stock also has the same weightage. So equal weighted index will tend to outperform the market cap weighted index, because despite the fact that the small cap stock has done well, in market cap weighted index, its weight would be very low. So its impact won't be known that much. So equal weighted index returns will exceed the price weighted return index, like that. Okay. Then there was fundamental weighting, and in fundamental weighting, the index provider decides which stocks will be included in the index based on fundamental analysis. So here value stocks tend to have a bias in the fundamental index, if you remember. Okay. Then whenever there is a stock split, stock bonus, whatever, so in a price weighted index, you have to adjust for the divisor. We had done such questions in class, so just be careful about that. You have to adjust for the divisor. Okay, fine, to account for stock splits and all. Okay, going ahead, which are the various types of indexes? Sector index, broad market index, where broad market index was what? 90% of market cap is covered. In India, Nifty 500, you can call it a broad market index. So 90% of market cap is covered in that index. Then there was style index, growth, value. Then after that, there was multi-market index, where in that same index, stocks of several markets will be included: India, China, Russia, Indonesia, Brazil, emerging markets, whatever. Then market cap index with fundamental weighting. if fundamentally I see the prospects of some country which are very bright, that country will receive a higher weighting in the index. In recent times, India has received a higher weighting compared to China in the MSCI index, Morgan Stanley Capital International Index. So that is based on what? Fundamental weighting. Yes. Okay, fine. So these were the types of indexes. Also, are there only equity indexes in this world? No, there are bond indexes. Bond indexes we had already discussed, and fixed income. Number of constituents in a bond index would be way higher as compared to equity, because not only there are too many issuers of bonds, but a single issuer also can issue many types of bonds that we had discussed. Turnover will be more as compared to equity. Now, the problem here is that bond indexes will not be measured on a daily basis, may not be measured on daily basis, because bonds suffer from one problem, and that problem is illiquidity. So price may not be readily known on a daily basis, which makes valuing it difficult on a daily basis. Right? Okay. Then we had commodity indexes. Now, one special feature about commodity indexes is that price of the commodity index is decided not on the underlying commodity price, but on the price of derivatives of the commodities, because most of the commodity trading takes place in derivatives market, because people want to avoid the storage cost and everything associated with that. Okay, fine. Then real estate index, we had repeat sales index. Repeatedly the property is sold for what price, so we get an average repeat sales index. There was REIT index, real estate investment trust REIT index, which is there in India also, but hardly a few REITs are included because it is still developing. And then there was appraisal index, Ready Reckoner. I had told you Ready Reckoner. Okay, average rates of a particular area, 2 BHK, 3 BHK, what are the ongoing rates? That is the appraisal index. Okay, fine. Now discussing about hedge fund indexes, are they so easily available? And in hedge fund indexes, what happens? As an index provider, I don't have access to data easily, so I have to be at the mercy of the hedge funds. They may provide only the good data where they are making profits and also. Then there comes biases, backfill bias, selection bias, remember survivorship bias, which we had already discussed in alternative investments. Okay, fine. So these are the various types of indexes. I hope you remember all this. Okay, now difference between rebalancing and reconstitution. Rebalancing happens when the weights change in the index. So for example, Nifty 50 is rebalanced on an automatic basis. So as and when Reliance Industries increases in price, its weight would automatically increase in the index. So that is rebalancing. Reconstitution is when the securities, the stocks, the constituents don't meet the index criteria, and thus they have to be replaced in the index. So in lockdown, I had told you that Tata Motors market cap had dropped significantly, such that it was no longer a part of top 50 companies in India. So it was thrown out of the index, and other stock replaced Tata Motors in the index. So that is an example of reconstitution. In India, Nifty 50 is reconstituted every 6 months. So if a case exists on a semi-annual review, if I feel that no changes need to be done in the 50 constituents, then it won't be reconstituted. It's not compulsory that जबरदस्ती reconstitution करना ही है. Okay, fine. Getting it? Okay, so reconstitution frequency and all will be decided by whom? By the index provider. The rules and all will be decided by whom? By the index provider, right? Who is the index provider of Nifty 50? NSE, National Stock Exchange. Okay, who's the index provider of Sensex? BSE, Bombay Stock Exchange, like that. Okay, fine. Any doubts in security market indexes? Just one more point, uses of index: reflection of market sentiment, benchmark of manager performance, uses in CAPM, capital asset pricing model. You remember all these uses of index? To develop index funds, mutual funds and all, when they want to launch new products, they make use of index and they launch index funds, like that. Okay, fine. Anything else that you want to know in this chapter? Calculations are a must. The price return, total return and all that stuff, adjusting for the divisor, very important calculations. Okay. Okay. Now I'm discussing overview of equity securities, out of which some part I've already discussed in first chapter, the cumulative preferences, and also not discussing it again. Now coming to GDRs, ADRs. Remember global depository receipts, American depository receipts. When a domestic company, say for a company in India, wants to raise capital in foreign currency, equity capital in foreign currency, then it has the route of ADR, GDR. Now what is the difference? American depository receipts are traded in which currency? US dollars. Okay, pardon, in US markets and traded in US dollars. And GDRs, global depository receipts, are traded in markets other than US and could be in any currency, and it could be in US dollar also. Also most of the GDRs are denominated in US dollars, right? Okay, so the primary difference between GDR and ADR is the destination of their trading. Okay, fine. Now in ADR we had learned 4 types: level 1, level 2, level 3, and rule 144A ADRs. If you remember, level 1 and rule 144A ADRs, were they listed? They were not listed. So what about the listing fees? Naturally low. Level 2 and level 3, were they listed? Listing fees high. SEC registration, was it required for level 1, 2, 3? Yes, SEC registration was required for first 3 levels, and it was not required for rule 144A, because rule 144A ADRs are privately placed. The investors themselves are sophisticated, so they don't need any regulation. Remember that we had discussed. And one final thing, ability to raise capital in US. Ability to raise capital in US. For first 2 it was no. For the last 2 it was yes. Okay, so could be testable, this table. And now when I talk about depository receipts, there were 2 types: sponsored, unsponsored. In what was the difference? In sponsored depository receipts, the voting right is with whom? Investors in the depository receipts. And in unsponsored depository receipts, the voting right rests with the depository bank. Okay, this is the key difference. Of course, in both the types of DRs, dividends ultimately will be given to you as investors, but the difference is in terms of voting rights. Okay, then can there be a basket of depository receipts which is as good as an ETF? Indirect investment in multiple depository receipts? Yes. Okay, are there arbitrage opportunities possible? Could be, because one DR, one depository receipt, could have backing of 5 shares. One depository receipts could have backing of 10 shares. So whenever a domestic price of the shares and the DR price differ, there could be arbitrage opportunities like that. So DR price is to a great extent driven by the domestic share price, right? Okay, fine. Thereafter we had done some accounting part in this chapter: return on equity calculation, price to book value calculation, and all that. Now those ratios I'm not discussing again. If you want to hear those ratios, watch the FSA lecture. Okay, there we have extensively discussed. Okay, now difference between statutory and cumulative voting. Statutory voting is 1 vote per share. Cumulative voting is basically, say for example, 3 directors are standing for elections and I have 100 shares. So 100 into 3, I will have 300 votes. Now that I can decide how I want to distribute these votes. A minority shareholder would prefer what? Cumulative voting. Okay, fine. It gives greater representation to minority shareholders. We had discussed the assumptions, the problems and all with this method also. Okay, fine. Thereafter in this chapter, what else do you want to know? What is the management's focus? We had discussed that, to increase the book value or the market value. Primary focus is to increase the book value and ultimate focus is to increase market. If they improve the book value, then only investors will pay attention and consequently the market value will be decided. Does the market value fluctuation of companies' equity shares affect the books of accounts? No. Okay, fine. And price to sales ratio, price to cash flow, price to earnings, all that ratios you know. Price to earnings ratio is what? Market price per share upon earnings per share. Now earnings per share as a concept you know in depth. Price to book value per share, so market price per share upon book value per share, and all these are valuation ratios. Now valuation ratios, do you see in isolation or you compare it to something? Compare it, either a cross sectional analysis or a time series analysis. Okay, greater the PE ratio and all means what? Investors are willing to pay more money for every one share of earnings. Okay, now growth companies tend to have a higher PE ratio because investors are willing to pay more for the growth prospects that the company is supposedly going to enjoy. For value stocks, the PE ratio and all is less because already the stocks have grown a lot in their life, like that. In terms of dividends, which stocks pay more dividends, growth or value? Value stocks. Growth stocks, not that they don't pay dividends, but they would comparatively pay lesser dividends because they need the money for growth purposes, right? Okay, anything else? Now again, I see in this chapter there is a lot of repetition. Your DuPont analysis and all, which we have already covered in FSA. What is a pipe private investment in public equity, which we have covered in alternative investments, LBO, leverage buyout, and all that is a repetition. Okay, fine. After that, we discuss equity valuation. Now, when it comes to equity valuation, the three broad methods that we had at level 1, discounted cash flow method. Within discounted cash flow method, we had DDM, dividend discount model, FCFE model. Now you don't have numerical questions on FCFE because that is covered at level 2, but FCFE as a concept we had learned in FSA. Okay, now the second method was multiple method, price multiple method. Then third method was asset based valuation method. The simplest of all to use was asset based valuation, total of all assets minus total of all liabilities. But do you consider book values or market values? Market values. But if market values are not available, then you can take the book values. Okay, now as regards the multiple method, you remember the price to earnings, it was a multiple. PE is called what? A multiple. So if the industry PE multiple is, say for example 8, and earnings per share of the company in question is 40, so intrinsic value as per me should be 320 if I choose the multiple method. Now you have to see the circumstances of case and all and accordingly decide the method. Arbitrarily you cannot decide any method and go on. Okay, multiple method I can use when there are at least some peers with which I can compare the company. But if there are no peers available, then multiple method would be difficult to use, right? Okay. Asset based valuation model could be used when a company has a lot of tangible assets. It is nearing liquidation. That is when asset based valuation would be useful. Or else if you want to determine a floor value, that at least the company should be worth minimum this much, so that is when again asset based valuation helps you. Okay, not suitable for such companies which have a high amount of what? Intangible assets, because then it wouldn't be reflected on the balance sheet, internally generated intangibles and all, goodwill stuff, etc. So asset based valuation will give a lower value to that company. EV by EBITDA method, that was again a price multiple method. EV by EBITDA, it was falling under multiple method. EV by EBITDA, earnings before interest, taxation, depreciation, amortization. EV was what? Enterprise value. Enterprise value was market value of equity plus market value of debt minus cash and marketable securities. Okay, fine. EV by EBITDA industry, EV by EBITDA multiple is say 11x, and EBITDA of a particular company is 30 crores. So what should be the approx enterprise value? 330 crores. Now I'm telling you one thing, that these are not exact values. These are just indicative values. When you go for negotiations in a mergers and acquisitions transaction and all, you can negotiate basis these values. Exact values, it's not possible. Understand that thing. And when it comes to discounted cash flow model, DDM, we had solved multiple questions. DDM, dividend discount model, terminal value. At some point you have to stop, right? Where the dividend growth stagnates, at that point you calculate what? Terminal value. So if you want to calculate terminal value P3, it will be what? D4 upon KE minus G. This is based on which model? Gordon's growth model, if you remember. Gordon's growth model. So if I just rearrange this a little, so and if I want to find out KE as per the Gordon's growth model, it will be P3 upon this will give me the cost of equity, just simple rearrangement. Now for you to be able to use the Gordon's growth model, you have to ensure one thing, that KE always exceeds G. Cost of equity exceeds the growth rate, because if it is equal to, then denominator would be 0, which doesn't make sense. I hope you understand that. And if KE is less than G, denominator would be negative. Can your price be negative? No, right? Okay, fine. Growth rate, if they give you in the question, well and good, but if they don't give you and then expect you to calculate, there was one formula, retention ratio into return on equity. Now you are masters at calculating ROE using normal method, traditional DuPont, extended DuPont, every method. RR retention ratio is 1 minus dividend payout ratio. Lesser the dividend payout ratio, more will be the retention ratio, the cash which the business is reinvesting in its own business, right? Okay, fine. More the retention rate, more the growth opportunities, more the ROE, more the growth opportunities, like that. Okay, fine. We had solved a lot of numerical questions. Dividend discount model actually applicable for such companies which actually pay dividends, which have a history of paying dividends. I cannot be using a dividend discount model to value a startup, because a startup pays no dividends, right? Okay, so for a startup, if provided there are competitors available, I can use the multiple method, or I can at max use a free cash flow model. Free cash flow, even if the company is not paying dividends, you can use the FCFE model to calculate the valuation, and practically speaking, that model is used a lot in calculating the company value. Okay, fine. Thereafter, we had discussed the disadvantages of price to earnings ratio, price to book value ratio, price to cash flow ratio. And here when I refer to cash flow ratio, I'm referring to cash flow from operations, from the core business operations. All these ratios could be negative, which render the ratio meaningless. So the advantage of using price to sales ratio was that sales cannot be negative, right? We had discussed that. Okay, thereafter we had discussed about dividends, the cycle, entire cycle. First is declaration date. Then during the declaration date, they also announce the holder of record date. Holder of record date. After that comes the ex dividend date, on which the dividend trades at, on which the share trades at a lower price, because if you buy the shares on ex dividend date, you won't be eligible for the dividends. And after the ex dividend date, finally comes the dividend payment date. So if you want to be eligible for dividends, please buy the shares before the ex dividend date, and before ex dividend date, the shares will trade at a higher price comparatively, because they are in demand due to the dividend eligibility. And once the ex dividend date is touched, the share price will fall, because the shares are no longer attractive, because you cannot get dividends if you buy at the ex dividend date. I hope you remember this. Now can you tell me what is going to be the monetary impact on your wealth if the company announces bonus shares? In the short term, your wealth would remain unchanged, because bonus shares may, you would be getting extra shares, but then price per share would fall, because many new shares are coming into existence. The supply of shares will increase, price will fall. Of course, long term effects will be there, but in short term, the effects would be unchanged on your wealth. Similarly, the case with a stock dividend. Bonus shares is actually a stock dividend, rights issue and all. Rights issue won't have the same impact, but whatever is given for free, stock split and all, it will have the same effect on your wealth in the short term. Stock split was what? 2:1. So every one stock will be divided, split into two stocks. So per share value would fall, but the number of shares which you have will increase, total wealth remaining unchanged in the short term. Reverse stock split is when your existing 10 shares, say for example, are combined to form one share. So reverse stock split, number of shares would reduce, market price would increase, because supply is reducing. That is, now reverse stock split generally sends a bad signal to the market, because it indicates that the company is desperate to increase the share price. maybe because it is a potential takeover target or whatever could be the reason. Stock split gives confidence to the market that the management believes in company's ability that it can increase the share price despite it undergoing a split. Buyback, so see, buyback is different. Buyback mein what happens is, if the company is buying back shares, it might believe that it is trading at a lower price compared to the intrinsic value. That is what, when they would want to buy back the shares. If the company feels that the shares are trading at a much higher valuation compared to what they believe should be the value, they won't go for a buyback, so then they will have to pay a greater price to the market participants. Buyback, what happens is, as a company, I will actually pay cash to the shareholders and buy back the shares from them. In reverse stock split, what happens, you shareholders have the shares. Say for example, you have 10 shares. Those 10 shares I will convert it to 1 share. I won't buy anything from you. Okay, so your per share value will increase, but the number of shares which you have will reduce. So again, total wealth in the short term would remain unchanged. Now, reverse stock split is done in extreme circumstances, but stock split you can see it not so often, but more often as compared to a reverse stock split, right? Okay. Maruti Suzuki was planning to undergo a stock split because the chairman of Maruti Suzuki had announced that we want to make the shares more affordable to people, and they believe in the growth opportunities. They wanted people to participate in the growth opportunities, like that. Okay, fine. So this was all about valuation. Also, where would you have more chances of beating the market, when that stock is tracked by many analysts or few analysts? Few analysts. Because if it is tracked by many analysts, it is already so overcrowded. So all the information mostly is priced into the stock. So if you want to outperform the market, small caps and all will present you opportunities, because it is not tracked by many analysts, right? Okay. And you should have confidence in your models. Intrinsic value, market price. The stock trades at market price or intrinsic value? Market price. Intrinsic value is the value which you feel should be the value. So can I say intrinsic value is a subjective estimate? Market price is objective. If market price is exceeding the intrinsic value, so what is your thought on that? The stock is overvalued. But if market price is below the intrinsic value, the stock is undervalued. Your undervaluation could be overvaluation for someone else, and that's how trading happens in the market, right? Okay. Anything else that we are missing out in terms of equity valuation? This was all. Just be careful in the DDM calculations and all. Chances of going wrong could be there. You can use the uneven cash flow function when you have finally decided the cash flows of each year, and then final discounting you can do with the uneven cash flow function. Just be careful to use the appropriate discounting rate, which will be what? Discounting rate will be the KE, cost of equity, naturally. Fine. Required rate of return. Yes, absolutely. Okay, K is also called required rate of return, the rate required by the shareholders of the company. Okay. Now finally, we discuss market efficiency. Okay, let me tell you, disclaimer, the underlying message of this chapter was that markets are efficient. No matter whatever they tell you, underlying message was markets are efficient. Now what is the meaning of markets being efficient? That all information is priced into the stock such that by you possessing that information, you won't have any added advantage over the others. Now, when we talk about market efficiency, we had learned the concept of efficient markets hypothesis. There were three types: weak form, semi-strong form, strong form. In weak form efficiency, by following technical analysis, can you expect to earn outsized returns? No, the technical analysis won't work. But by possession of public info, can you expect to earn extra returns? Yes. By possession of private info? Yes. So then what was semi-strong form market? You cannot expect to earn excess returns by following technical analysis. You cannot expect to earn excess returns by following fundamental analysis, that is using public data. The only form of earning excess returns is having private info, that is semi-strong form efficient. So can I say a market which is a semi-strong form efficient is necessarily weak form efficient? But a weak form efficient market may not necessarily be semi-strong form. And now the last one is strong form market efficiency. Strong form market efficiency is when you cannot earn excess returns by anything, neither by technical analysis, neither by fundamental analysis, neither by possession of private info also. Okay, that is strongest form. Now let me comment that efficiency is always rated in a spectrum, low to high. You cannot say that efficiency is highest 100% or it is 0%. It is somewhere in a spectrum. Higher the better. Okay, so that disadvantage reduces. Okay, fine. If I am using technical analysis, what is my belief? That the market is weak form efficient or weak form inefficient? Weak form efficient says you cannot earn anything by following technical analysis. So my belief is that the market is weak form inefficient. Inefficiency is when I can use my beliefs. If I believe that market is semi-strong form inefficient, I can not only use technical analysis, I can also use fundamental analysis. Fundamental analysis means public data. Also, when they say technical analysis, sometimes they could use such words market data. Market data means past price and volume data. Okay, so that means your technical analysis. Okay, fine. After that, we had discussed various anomalies, if you remember. Now, when I discuss anomalies, they had classified anomalies in several types. One was anomalies in time series data, anomalies in cross-sectional, and other anomalies. Time series data matlab company's own past performance. Cross-sectional data means comparing it to peers. Okay, now what were the anomalies in time series data? One of the classic anomalies that we had discussed was the January effect. That initially it was observed that stocks fall in December month and they rise again in January month. It was classified as an anomaly, but then the book says that now investors know of this, so that the advantage of an anomaly is no longer there. It has been removed now because everyone knows that. So no one will earn extra returns by possessing this information. And we had discussed why markets were falling in December and rising in January. Tax loss, selling, window dressing, those two reasons. Turn of the month effect, turn of the year effect. Remember all that which we had discussed. Now, your studies results highly depend on the time period selected, on the data selected. Your result, would it remain the same throughout, or it could change based on the time series, time period selected, and your sample size and all. So many factors are dependent on your your result is dependent, I mean, on so many factors. So once you conclude something, it is not so rigid that it can never change. But these theories and all are based on some past studies done, and the conclusions are accordingly based. So that is why your institute has given a disclaimer that it may appear an anomaly as per the research methodology used. But now if you again do this test, it may no longer appear to be an anomaly because things do change with time, right? Okay, now discussing about overreaction and momentum anomalies. Overreaction was what? If momentum, first of all, let's discuss momentum anomaly was what? If a stock increases in price, continues to increase in price. If a stock decreases in price, continues to, that was momentum anomaly. Overreaction anomaly was what? A bad news, if it is announced in the market, the stock falls a lot. That is overreaction effect. If a good news is announced in the market, the stock increases a lot. That again is overreaction anomaly. But data becomes slowly available gradually, like that. Now, anomalies in cross-sectional data was your size versus value effect. Now, it was proven in a study that small cap stocks tend to outperform large cap stocks. Now, this is proven to be an anomaly. Now, what the curriculum says is that was basis the study conducted at that point of time. If you conduct a study again, or maybe using different data set, that may no longer appear to be an anomaly. That anomaly which appears could be due to some faulty research method or faulty reasoning. So that's what I told you initially, that the underlying message is that there are no anomalies as per the institute book. It is always that the market is efficient. Okay, which may not necessarily be the case. There could exist anomalies, and as I said, the market efficiency always falls in a spectrum. Neither it is never on extremes, neither 0% nor 100%, like that. So US markets may be more efficient compared to Indian markets, but they are not fully efficient. still there is scope to earn outsized returns. Yes, absolutely. It will be subjective. And tell me one thing, if you believe that markets are highly efficient, will you go for active management or passive management? Passive, because knowing that by doing active management, by putting in so much of efforts, you are not going to be able to earn any returns in excess of the market returns. So better to go for passive investment. You will save on time, money, efforts, everything. Okay, fine. Now, anomaly between in cross sectional, I'm discussing one more, value and growth stocks. It was found out that value stocks tend to outperform growth stocks. Now they have termed it as anomaly, but then they are saying no, it is not an anomaly, because value stocks, they provide you more resilience during market distress. So value stocks won't fall as much as growth stocks. That is why they are outperforming the growth stocks. So that was the reasoning that they had given to not call it an anomaly. Now, when I discuss about other anomalies, it was closed end investments. So you have arbitrage opportunities when it comes to ETFs. So whenever, see, ETF, the price at which ETF is traded is based on demand supply conditions. But then if there exists an arbitrage opportunities, matlab the price of ETF, price means the price determined on the basis of demand supply, is not equal to NAV, net asset value of ETF, then there exists what? Arbitrage opportunities. So in order to prevent, market participants will keep capturing these arbitrage opportunities such that price of the ETF will be close to the NAV. Even if slight difference exists between the price of NAV and I go to exploit the arbitrage opportunities, what will eat up my arbitrage returns? The transaction cost. So the point is, the difference won't be so huge such that you can make an arbitrage like that. Okay, fine. Then earnings announcements. Earnings announcements was on the period of earnings announcement. If there is positive earnings announcement, your stock price will keep going up. Similarly, overreaction, what we had discussed, it was more or less the same. Earnings announcement. Thereafter, initial public offerings. It was found out that IPOs on the day of their market listing, they tend to give superior returns, and it was called an anomaly. But then they refuted the claims by saying that if you see the performance over longer time periods, the performance becomes average. So it is no longer an anomaly like that. And in fact, some of the cases we have observed that on the listing day gains were outsized gains, but then if you see the long term performance, the gains are not so great like that. And finally, economic fundamentals, right? Okay, now one more thing, you might get such MCQs: what will contribute to increasing market efficiency and what will contribute to reducing market efficiency. Now, as a regulator of India, say I'm SEBI, I put restrictions on foreign investors to trade in markets. Increase efficiency or reduce? Reduce efficiency. I put restrictions on short selling. I encourage brokers to charge lower brokerage fees so that more and more participants could trade. Increase market efficiency. I put restrictions on arbitrage, reducing market efficiency. Arbitrage, I had told you some amount of arbitrage is healthy for the markets, because markets are not perfect. Imperfections do exist in markets also. Arbitrage will correct the imperfections such that it will trade close to the intrinsic value. So do let traders enjoy arbitrage so that they will bring in efficiency to the market. So if you prevent arbitrage opportunities, you are reducing market efficiency. Restrictions on insider trading increase market efficiency. Why should someone have fun at the expense of others? So if you restrict insider trading, it will definitely improve market efficiency, right? Okay, so all these were the factors that we had discussed. Anything else that you need to know? Okay. Herding is what? Mimicking the action of other investors. So what was happening in India? What used to happen? Late Rakesh Junjunwala, whatever trades he used to make, people used to blindly follow him. That was the concept of herding. It's the same. Okay, fine. Right now also, if successful investors take some trades, other market participants will follow them, thinking that they must have done something right only. But then I had told you how in penny shares and all, people are trapped. Pump and dump schemes and all that stuff. Okay, clear. Highly theoretical chapter. You have to read all the theoretical chapters extremely well. Okay, from anywhere they could test you. but conceptually you should know what it is.